Hello, this is Tim Congdon, Chairman of the Institute of International Monetary Research at the University of Buckingham. This is a presentation given in August 2019, and I'm going to be updating you on the global monetary picture and the prospects for the main economies in coming quarters. The key question at present is, will there be a global recession in 2020? My answer to that question is no. Getting that answer, I'll be reviewing two main kinds of evidence, but it's worth saying at the start that the kind of argument being presented for those people who believe there will be a recession next year depends on a rather technical, arcane concept known as the yield curve. The yield curve is the curve of bond yields at 6 months and 1 year at one end, and then 20 years, 30 years, indeed ultimately no repayment at all, at the other end. Normally, yields on long bonds are higher than on short bonds or in the money markets, but at the moment there is an inversion of the yield curve. And some economists say that this inverted yield curve is a leading indicator of recessions. Well, it has been at some times in the past, and other times in the past it hasn't been. It just depends on which episode you look at. And I tend to feel in this subject that there's something of a catch-22 here, that you ask people, why is there an inverted yield curve? And they say, because there's going to be a recession. Then you ask them, why is there going to be a recession? They say, because there's an inverted yield curve. The truth is that the relationship between bond yields and economic activity is not that precise. And I prefer to look at two other types of evidence in order to get a handle on what will happen in the next few quarters. First of all, I look at money trends. The growth of money is the ultimate determinant of the growth of nominal GDP. There's quite a bit of inertia in inflation in the next few quarters, much of which is given by expectations by institutions and so on. So when you get an acceleration in money growth, you tend to have buoyant asset prices and above-trend growth of demand. When you have a deceleration, you have beneath-trend growth of demand, or perhaps even falling output, and weak asset prices. These general rules of thumb that I've applied in my career over the last 40 years. Now, at the moment, if you look at the world's largest economy, the United States of America, the chart of money supply growth has got a rather clear message in itself. I wouldn't get too excited about it, but you can see that the 3-month annualized growth of broad money is more or less the highest it's been in the last decade. The annual rate of growth is over 5% and is also quite positive for the economy. The talk about recession in the United States has got seriously overblown. The current level of consumer spending is rather buoyant, and the only really big problem for the United States is not actually the United States itself, it's actually what's happening in some of its trading partners, what's happening to exports, and so on. There is nothing to worry about, in my view, about the US economy for the next year or two. Let's then look at a range of other countries. I did this a couple of months ago, and the story remains much as before. There has, in fact, been a still pretty good growth of money in the Eurozone. Surprising in a way, because the growth of bank lending is much weaker than before. But what's happening is the Eurozone is pulling in money balances from the rest of the world because of its balance of payment surplus. In China, money growth runs at the same sort of rate as it's been at for the last 2 or 3 years. If I looked at these numbers, there are some points of weakness, notably in the UK. They'd be also true of Australia, if we included Australia. But the broad picture is one of actually rather strong growth of money rather than weak growth of money, and that is actually giving, therefore, a helpful message for asset prices and demand in the next few quarters. Now, and I'd say that, we can't predict exactly what will happen in the second half of this year and early next year, but the safest forecast as of now for 2020 is of trend growth in the world economy with very low inflation, and again, another very good year in those senses for the world economy. Now, money is very useful, and I've used it a lot in my career, but it's not the whole story. We do also look at leading indicator indices, where what economists do is to combine as much information from surveys, orders, and so on about the next few months as they can, and then bring it together into an index, and then from there to make statements about what's going to happen, say, in the next 6 to 9 months. Now, very helpfully, the OECD in Paris does this for us, and they have a leading indicator for the OECD area, which is about, well, rather more than half of the world economy. So we need to combine our discussion of money trends every now and again by looking at a leading indicator index. You can see this index rose strongly in 2006, 2007, and then plunged. So it did capture the Great Recession phenomenon pretty well. And then you see since then, more or less a straight line with some wobbles. Now, it's perfectly true that at the moment one of these wobbles is downwards. But there were wobbles downwards also in 2012 and 2016, and no recession followed. 2016, we had economists forecasting recession on 3 different occasions. There was a forecast of recession just after the Davos conference. There was a forecast of recession in the middle of the year. There was a forecast of recession after the Brexit vote. All these forecasts turned out to be wrong. And I would suggest that what we're going through at the moment is, again, one of these wobbles. We did actually suggest 18 months or so now that there would be a global slowdown in late 2018 and 2019. That's been correct. But in my view, looking at this chart, looking at monetary evidence, there is nothing to indicate anything seriously the matter with the world economy. The newspapers are full of worries about the trade war between the United States and China. I quite agree that's a negative, not just for the business cycle, but also for economic efficiency. And it's not very clever what these moves to protectionism. Having said that, last year, China's exports to the USA, which is the area of vulnerability, were just over $550 billion. Its imports to the USA were about $180 billion. Well, global output is estimated by the IMF to have been almost $85 trillion, $85,000 billion. So China's exports to the USA were roughly 2/3 of 1% of global output. If China's exports to the USA dropped by 1/4, that would amount to 0.2% of world output. Important, but certainly important in relative to growth rates, but really a flea bite in the larger picture. And it's very important to realize in all this hullabaloo that if Chinese exports to the USA go down because of tariffs, there'll be 2 reactions. One is that the Chinese will send their products elsewhere, and then third-party countries will step in and replace the Chinese exports, just a substitution. And also, of course, what will happen will be that the Chinese send some products in a semi-finished state to Vietnam, Bangladesh, or whatever, and then they're exported from Vietnam and Bangladesh as finished products to the USA. So there are various ways in which the effect of the tariffs will be bypassed, and so the full damage won't be 0.2% of world output. So we're talking, frankly, about a flea bite. And let's just be clear that there are, at the same time, going on in the world, various measures to liberalize trade, including there is a new trade agreement, for example, between the European Union and Japan, which is a movement towards trade liberalization. So I think that the concerns about all this are rather exaggerated. There's also some talk about Brexit, uncertainty, worries, and so on. Let's just be clear that the UK accounts for about 2.5 to 3% of world output. Exports to the European Union from the UK are about 12% of UK output. The UK can replace almost anything that it currently imports from the EU by importing from the rest of the world. Even in an extreme negative situation where trade was to stop completely, life would go on, but that won't happen. Again, this is hysterically exaggerated and overdone. I'll just say here that I'm not in favour of anything hysterical. I'm very much in favour of continued free trade between Britain and the EU, but that may not be what happens at the end of this year anyway. Economists therefore have we're trying to forecast the future, and what I've used in my career is looking at money trends and also sometimes looking at leading indicators. I can see no basis for expecting a recession in the world economy or even in any major economies in 2020. All sorts of shocks and upsets are possible in late 2019 and early 2020, but the key central banks don't want a recession. Inflation is very low, and at the moment it's falling because of oil prices having come down. So in my view, the safest forecast for 2020 is another year of roughly trend growth of demand and output with very little inflation. Thank you.